All right, so began the show with a clip from The Last Jedi, and we're going to finish it with a little bit of a take on Empire Strikes Back, a twist. My next guest says that everything strikes back in 2026, so let's bring in NewEdge Wealth, their Chief Investment Officer, Cameron Dawson. All right, so the stage is set. It feels like the stage is set for the market to take off next year. But it's also, these last few days, it's been hesitant. What's going on?
Yeah, it's really the question of, will we see the rest of the market take off? Because we know that the last 3 years have been extraordinarily narrow, with Mag 7 being leadership. And if you look at current consensus earnings forecasts, there's an expectation that you're going to see a big recovery in the 493, and the Mag 7 will stay strong, but not nearly as strong relative.
So here's just one of the tables to talking, what you're talking about. So again, the blue, the largest 7, 23, then they go to 18. In the meantime, the rest start going up. There's some other estimates out there that show the 493 even coming on stronger.
Yeah.
So this to really get to the point that it's about the rate of growth more than absolute growth?
I think that's really important. Markets care about the rate of change, what you might hear called the second derivative. And so the question will be, do you see a deceleration in the Mag 7 start to weigh on growth? And I think it's important to note, Mag 7 has not been a monolith this year.
Right.
You actually only have 2 Mag 7 names that are outperforming the S&P 500, Google and NVIDIA. So the question will be, do you start to see even more kind of broadening out of the market? I would note, though, that this is a pretty high bar for the rest of the market to broaden out, which just means that maybe there's some room for disappointment in some of these equal weight earnings estimates.
Well, also those cyclical names have been doing pretty well.
Yeah.
And you even point out maybe as a harbinger or as a proxy for the overall economy, equal weight discretionary over staples, commodities and materials, industrial names, machinery over waste, transportation perking up. These are also signs people use to judge the economy. So will the economy provide a sort of backdrop that we would need for a nice rally?
I think the market is a fantastic tool to help keep us honest when we're making predictions. And if you think about all the hemming and hawing about the U.S. consumer over the course of this year and worries that tariffs would cause the consumer to fall off a cliff, we kept looking at the equal weight discretionary versus staples. It stayed in an uptrend, which just suggested to us that the equity market was saying the aggregate U.S. consumer is still okay. Not to say that there aren't pockets of the consumer that are struggling.
Sure. GDP growth then right now for the third quarter is pretty high.
Yeah.
Do you have a call on that for next year?
So right now consensus is at 2%,
right.
And that's not too industrious of a forecast, just because 2% is effectively average. So when we look at consensus forecasts, it seems like nobody really wants to take a side. I think the thing that's interesting is that will we see that 2% continue to move higher? That's important for risk assets. Risk assets need rising forecasts. It's one of the reasons why the market has been so strong over the last 6 months. So if we start to see those forecasts hit a ceiling, that could be a reason why we could see more volatility.
So history tells us that the kind of years that we've had means that we borrow from the future, and some are saying the next 10 years, nothing. I mean, you're not in that camp, are you?
So
give us something.
Look, we all have seen this chart where you
Right.
look at long-term valuations,
Right.
and it says very scarily that you're going to have very low long-term returns. The thing is, this does not mean to be uninvested.
I got you.
Because the path is important.
Gotcha. Cameron, you're wearing all black and you still look festive. Thank you very much.